there. It just popped up and said it's being recorded.
Great. All right. I'm admitting everybody.
Okay.
All right. Hello and welcome. Hopefully you are here for the financial basics for small business owners, part of the SBDC for Indiana. My name is Paula. I see we have 2 online. I know that today's group is actually going to be pretty small, but that's actually very advantageous because it allows you to be more interactive and you can ask questions. You can be on camera or off camera and just active in the chat. I will be monitoring that as well as giving the presentation. I'll also be giving some prompts and just would love to hear a little bit about your business, what you're starting, what phase you're in, what you're doing, and we can have little chats and talk about maybe when I go over these financial basics, what you might be struggling with and what you could need help on or where you need guidance and things like that. So that's actually a really nice thing to have smaller groups. If you want to just go, and this is being recorded. I don't know if this will be posted on YouTube or not later, or if this will just be shared. Christy, she's my counterpart.
Yeah, the link will be in Neosera, plus it'll be on YouTube.
Okay. Okay. So everybody knows in case, you know, you don't want to share something that goes public. All right. So we can start with, I'll start with my introduction. So this is Financial Basics for Small Business Owners, and I'm a consultant with SBC, Small Business Consulting. It's a bookkeeping and consulting firm. And we help small businesses start their, wherever they are, whether it's an inception of the idea, if they're just getting going, or if they're looking to grow. That is our mission, is to help people realize their dreams of entrepreneurship and growing their business. So who am I? My name is Paula Herkamp. I am a small business and bookkeeping consultant. You can find me on LinkedIn here at Paula A. Herkamp if you want to reach out and connect after the webinar. And I'm a QuickBooks Level 2 certified pro advisor, so I know QuickBooks in backwards and forwards, inside and out. Today, we're not just going to be talking about QuickBooks, though. We're just going to be talking about the basics of finances, and the bookkeeping is a big piece of that when you're talking about the landscape of your financial world when you're starting a business and maintaining a business. I'm also QuickBooks payroll certified, so if you have questions on having payroll and paying people, I can help you out there. I'm also a serial entrepreneur. I've started several businesses in my life, including like a body care soap making business. My family has had rental properties. I have a bookkeeping practice, and yeah, I feel like I'm always starting new things, a print on demand little store, things like that. So you name it, I've dabbled, and I'm always thinking about businesses, how to monetize things, and how to grow. So I would love to hear from you, where you are from and a little bit about your business. If you want to put that in the chat, or if you want to unmute. And while people are filling that out, move forward. And we can talk about what are we covering today. Some keys to success. We're going to talk about some bookkeeping basics, simple 4 steps process on bookkeeping basics, some things that you just want to cover on a routine basis on a monthly cycle, to make sure that you are keeping your books and that everything is being accounted for properly, and how to double check yourself. We're going to talk about business versus personal finance, and how not to get too mired in working them together, which is called commingling. You want to not do commingling. You want to keep your business versus personal finance is very separate. We'll talk about the 3 financial statements that every financial institution uses to evaluate your business. It also helps you as a business owner track the health of your business. And it helps you do some forecasting, cash flow basics about how to run like a 30-day plan on your cash flow, and budgeting for operations and growth. We'll talk about funding readiness and the basics for that, what lenders look for. And then we'll finish off with some free one-on-one technical assistance and next steps. So this will just get you started, and hopefully you will be on your way to getting more financial guidance and tightening the screws and getting your business launched or growing wherever you want to be. So I see in the comments here, it says, hey, I'm Mary. I have translations and interpretation services, business and topics related to agriculture. I'm in Warren County. All right, so this is a translation and interpretation services business. I see from Jen, it says, my dog is always barking, so I will type instead of muting. Okay, I'm a full-time teacher and professor in Indianapolis who recently completed a certification course to become a moderator or a mediator, excuse me. And I'm working on starting a domestic mediation business, Collective Pathways Mediation, to assist people with their mediation needs. Wonderful. So we have 2 service-based businesses. That's really great. All right. And so now that I know a little bit about your business, what stage are you in your business? Are you just thinking about it, or would you consider yourself a startup? Like maybe you've done some of the first basic steps, or would you consider like you've kind of had a few clients and now you're trying to like scale and grow? You can just type A, B, or C in the chat. Okay, I see a B, so startup, and an A. Okay, and another B. All right, great. So we're here to lay down some foundations. So let's get to it. All right, so bookkeeping basics, the 4 keys to success. You want to keep a very simple chart of accounts. When you think about your bookkeeping, I'll help you break it down, but you'll think of it like your expenses, all the money that you spend, and all the money that comes in. But it's easier to think of it in terms of it going out as buckets of like, you're going to be spending it on operational costs. Are you going to be spending it on insurance? Are you going to be spending it on rent, perhaps? And so every bucket or category that you have an expense in, it would be one of your items in your chart of accounts. And you want to keep the overall buckets very simple. So that way you can categorize things consistently and you don't get confused, and you can just read it and look at your reports because it will have those same categorizations. And you'll know it, and it'll be simple and easy to just say, oh, these are ingredients, this goes here. These are office supplies, this goes here. This is rent, this is my, software program, this goes here. And monthly, whenever you have an expense, this is a meal, a sales meal, this goes here. So keeping a very simple chart of accounts, that's one of the very big keys. You can always get more complex later, so start simple. Number 2 is you want to categorize all transactions accurately. And like I mentioned, you want to do it consistently. So 1 month, you don't want to say, oh, I have a category that's for office, like digital office, and then I have a category that's software. And then sometimes I do Microsoft Office in the office category, and sometimes I do it in software. You want to make sure that you're very consistent, and that allows for the most accurate tracking in your finances. So that way, for sure, this is what I spent on this. I can clearly say this is what I spent on this. Number 3 is reconcile monthly. And that's a process I'll talk a little bit more about. And that's just basically comparing your monthly statements of the bank to what you have in whatever system you're using to track your bookkeeping in. And you want to do this on a monthly basis because it keeps everything fresh in your mind. And it gives you enough time to do any corrections if you need to, or ask a tax accountant or a tax preparer any questions. It's just a kind of a nice rhythm so you don't fall too out of sorts with your books. And then number 4, you want to review your reports. So hopefully you're able to use software. Some people do their bookkeeping on spreadsheets. but it doesn't usually generate sophisticated reports for you, not like QuickBooks or Xero or Wave Financial. They will be able to do that automatically for you. And they're very useful. We'll talk about the reasons why, both for lending, for looking at the health of your business, and for forecasting. These reports are very useful. So these are kind of the 4 basics to success. So number 1, the chart of accounts. Again, I mentioned they're the buckets of all the categories that your expenses are going to fall into, and even your service revenue. If you're doing revenue, you're getting sales by doing services. Maybe you have one-on-one mediations, for instance, right? That is one category that you could do for expenses. Or you could have maybe group workshops, right? Where you help people in a group. Or maybe you do like a webinar and you teach people kind of some basics, like what do you need to bring to the table? And so those could be different revenue streams, and those would be in your chart of accounts if you wanted to separate those out. And then for your expenses, again, I mentioned earlier, office supplies, your software, your tech stack, your rent, if you have that, any other insurance that you might have, graphic design work, things like that nature would be in your chart of accounts. And kind of even on a higher level than that, with the chart of accounts, there's your chart of accounts will fall into 5 of these basic categories. An account is either an asset, so something that you own in the business, and that includes like your cash. It includes if you have any intellectual property. If you have a building or something like that, that's an asset. Your furniture, your computer equipment, all assets. A liability, and those are things that you owe to someone, whether it's outstanding bills, credit cards. If someone has prepaid for services that they haven't received yet, that's a liability until you're able to deliver those services. In equity, and that's kind of the value of your company. Income, obviously the revenue that you receive when you sell your services, and expenses, so money that goes out the door. And then everything, and then you'll have subcategories within these major 5. Yeah, so that's what I wanted to talk about here. And also there's a little note here that says in bookkeeping, it's a broad term. And it's not just meaning like a bank account or a credit card. It's actually the action of looking at your books, categorizing your all your financial transactions into these 5 master categories and the subcategories within them. And looking at your reports, that's all bookkeeping activities. Even paying your bills is considered bookkeeping or accounts payable. Receiving the money and matching it to invoices, that's accounts receivables. So that's all bookkeeping and all good stuff. It's all normal stuff that you do every day. It's just in the more financial terms and financial jargon. All right, so drilling a little deeper on those big 5, I have 3 here. Asset, so it's something that the business owns that has value. So like I mentioned, bank accounts, accounts receivable. So when you send out an invoice because you've rendered services, that's considered an asset. That invoice has value because you're going to collect on it. And so that's considered your accounts receivable. You will receive that money. Your equipment, like I mentioned, computers, if you had any special presses, if you were producing like soap, for instance, property, if you own a property from which you work, or if you have like a tent or booth space, the equipment for all of that, if you do on-site services, that would be considered property. And then a liability are things that you owe. And those things also have value. So like a loan, a credit card, accounts payable. So bills that you've incurred that you have not yet paid would be accounts payable in various different forms, whether you pay, your auto insurance bill, monthly, whatever bills that you get that are related to your business. And then equity, it's the value of the business to the owner. And this you don't usually have transactions in, but it will show up on your balance sheet, which we'll talk about. And it's something that people in the financial world will use to kind of evaluate the value of your business. How much you pay yourself and how accurately you track your business and personal transfers. It's all part of the valuation of your company. And so like if you're an LLC, you could pay yourself through what they call an owner's contribution, and that shows up on your equity because you're paying an owner's draw, because you're drawing from the value of the business, part of the equity. And so you would be paying yourself as owner's draw. But on the similar side, when you put your personal money into the business and you just say, I'm going to seed this bank account with $500 so that way I can do all my business spending from it, that would be an owner's contribution. And that would be part of the equity account. And then SP is sole proprietor, and then partnership. And it's also very similar with equity of owner's draws, owner's contributions. When you're moving into higher territory of like S Corp, it doesn't work out that same way. But I think most of us here are probably in a smaller, maybe a solo entrepreneur, maybe an LLC formation. All right, and so then the other two accounts, we have income. So that's any money that comes in that you receive in exchange for goods or services. So it doesn't count like interest. If you have a bank account and you're getting interest on that, that would be considered other revenue and it would show up somewhere else. But any money that comes in from a good or service that you have performed or delivered to a customer or client. People use the term income, revenue, sales. It's all the same thing. And then expenses, we all know what that is. You have two types of expenses. You have like a direct expense, also called a cost of goods sold. It's easy to think of this in terms of like a physical product. So when you're making, like say, baking bread, your ingredients that go into that product is a direct cost because those ingredients, you can't make your product without those ingredients. In the service world, if you have sub-consultants that work for you, and you can't deliver your services without their help, they would be considered a cost of goods sold. And it's directly resulting in revenue. So their work in doing their sub-consulting, you can bill for that. So you can call them a cost of goods sold. Just like the flour, the salt, and the yeast going into the bread is a cost of goods sold that goes directly into the product that results in revenue. And then you have your indirect expenses, which is everything else, right? The rent, the insurance that you pay. So all of your overhead, the electricity, the utilities, operating expenses, things that you just have to get, your licensing. If you do any networking events, if you print out business cards, right? If you pay for your website, those are all indirect costs as part of your business that you would incur. That doesn't get categorized out when you do your bookkeeping, but it is just kind of nice to know in terms of like how you think of your expenses. Because sometimes you can control one or the other. Obviously, you don't want to damage or reduce the quality of your product by reducing your cost of goods sold by buying really cheap ingredients. But sometimes if you look at your overhead and the indirect costs, those are usually fixed and they don't grow too much or shrink too much depending on how the frequency of your business. So it's a little easier to track. All right. So another really big piece of advice that I can give to new business owners, to anybody running a business, but do not mix personal and business spending. That's called commingling of funds, and it makes reporting like year-end taxes really difficult, but it also makes it really difficult for you as a business owner to truly see how your business is doing. And so the best practice is you open up a separate bank account. Even if you don't have a separate EIN, if you are practicing doing a business, just open up a separate business account, use it just for business. So that includes to receive money and it includes to pay all of your bills through that account. If you need to do an owner's draw to pay yourself from that account, you can record it as an owner's draw and keep track of that. And if you need to put money into that, you could count that as an owner's contribution. But use that separate account to track everything business related and don't mix the two. If you accidentally paste a personal thing with your business account, you can always settle that on the bookkeeping side and just write that off as an owner's draw, right? Because you paid for it by accident for a personal thing. So it's you taking money out and it's an owner's draw. And if you accidentally put money into the account, like if you buy something using your personal credit card, but it's for the business, you can say that that's an owner's contribution at that stage. You can log it like that. But best practice, just keep them separate and you will be really, really well off. If the mixing happens, right, you can just fix it, like I mentioned below, the owner's contribution or investment, and then the owner's draw. So keep your owner pay separate from business expenses. The pay shows up as equity. It shows up as an equity account and not as a business expense. Once you have employees, then it would show up as expenses. If they were subcontractors, either as cost of goods sold or as an indirect expense, as like payroll. And so don't ever categorize personal spending as a business expense, because again, that messes up your taxes and can leave you open to liabilities if you're an LLC and you're looking for that protection, because it just shows that you're not keeping everything separate. And you want to have that. You don't want to, there's a term, it's called piercing the veil, and you don't want to do that. You want to just truly show like full transparency. These are my monies in, these are my monies out. This is where everything went. Another good reason not to commingle is because if someone is looking to invest in your business, having clean financials shows them they can have confidence knowing that what they see on paper on the reports is actually what the value of the business is. If you're like, oh yeah, that's for my side project, this and that, or this is what I pay my school's kids fund or something, my donations, then it's like kind of suspect and people can't really get a sense of what the value of your business, either for giving you a loan or for investing in your company. All right. So I mentioned with the chart of accounts, you want to keep it as simple and clean as possible. And most businesses use only a handful of accounts, right? And again, you could start really, really simple and you can get a little bit more specific, but these are kind of the ones, right? A checking account, a credit card account, which I don't even have, but you could have a credit card if you wanted to. Owner's draw, investment equity, that automatically comes up whenever you open QuickBooks or any software, Xero or Wave. Income, obviously sales, like where are you going to put, and you could have one line item. It could just be like income or revenue. Cost of goods sold, if that applies to you. If you are a service-based business and you don't have any subcontractors, you wouldn't have cost of goods sold. Rent expense, if you even have that. But maybe if you have a booth somewhere or if you rent a little office space for a day, that would count. Utilities, also kind of the same. If you work from home, you have to be somewhat careful about using your home as an expense and writing that off on your business, because you have to really show that you do not use any of your home area, office area for home use. I've even seen people who have offices with a padlock on it to show that it truly is a separate office, that they don't do anything personal from it. Talk to your tax advisor to see how strict people want to be on that. But the advice that I have received in the past is it can get a little bit shady, especially if you're trying to claim a large portion of your home. But you can do it. Talk to your tax advisor. Just know that that's something to think about. Insurance, obviously, that's an expense, whether your professional liability insurance, errors and omission insurance, if you want to have a company car, your auto insurance, things like that. Your marketing expenses, advertising, again, those business cards, setting up a website. If you do any paid advertising or something on LinkedIn or boosting ads or posts on Facebook, things like that. Software subscriptions, everybody now has like an AI tech stack or software platforms. That's a one that everybody has. Business related meals, travel, professional fees, and of course with your own industry, you might have something like licensing, right? Licensing and whether it's state licenses, business, tax, like setting up your business fees, licensing fees, as well as professional licensures could also be an expense. But keep it simple. And so that way, once you start performing what they call financial transactions, and every time a transaction happens, that's either when money goes out, money goes in, or if money transfers from account to account, whenever the money moves, that's considered a financial transaction. And that needs to be recorded in your books. And so when you see the money come in, or if you see the money go out, you want to be consistent in categorizing it in those same buckets every single time. You want to categorize it by what it was for. So if you look at the categories that I showed, these are all general categories, what the expense is for. It's not by vendor. So that's very important. I have seen some books where people are like, this is my Amazon chart, category. And it's like, no, that's not a category, because you can buy so many different things from Amazon, right? You can buy a computer equipment, which would be considered an asset. You could buy office supplies, you could buy food, you could buy, you name it, right? And so you want to categorize the transaction for what it was for, not by the vendor. Use your business accounts for business spending only, keeping your owner pay separate from business expenses, like we mentioned before, and then recording transfers as transfers. So if you have a savings account and you also have a business checking account, when the money moves from one side to the other, in the bookkeeping world, you're not making money, you're not spending money, it's a transfer. Similarly, when you're paying your credit card off, that's not an expense. And that's like a big mistake that I see some people do is in their books, is they will say, oh, this is my Amex expense. When the transaction happens on the Amex card, it should get categorized under the Amex account. And once you've categorized it in the Amex account, it is categorized, that transaction has been recorded. And so paying off that credit card, if you recorded it as an expense, you would be duplicating the money that's left, that's exited your business effectively. And so you don't want to do that. It would be recorded as a credit card payment, which is effectively a transfer. You're transferring it to eliminate the liability, or basically what you owe from that credit card, away from your cash account. So payment processor deposits are not just sales. That's another thing. If you're using Stripe or PayPal, there's so many different Square. There's so many different kinds of payment processors, and they often have embedded with them some fees. And so you want to make sure that you can split the transaction, and every platform will let you do that, to split it, similar to like when you pay your mortgage for your home. You're not just paying your mortgage, you're paying interest, you're paying your escrow fees, you're maybe paying for insurance, additional insurance. It's all bundled into that, and you're supposed to separate it out per the transaction to make sure everything's captured. If it's sales tax, also, like that would be separated out. And there's always a memo line that you can use for unusual transactions. And I would definitely say use that if something unusual and you're like, I'm not going to remember this, or if you just want to refer to it, that's a good thing to do. And then finally, you want to review any items that you haven't been able to categorize monthly and resolve it. Like either assign it, decide like what category it belongs to. If it seems like it's a reoccurring thing and you're like, I really think I should track this separately, do it. Create a new account, a new chart on your account that matches that category of what your expense is or whatever that transaction is, and then just capture it consistently going forward. All right, so common mistakes. I mentioned some of them on the previous page because I can never help myself. But loan payments, separating out the principal versus interest. Credit card payments, usually a payment and transfer, not an expense. Transfers between bank accounts, you're not making money, you're not spending money. That's just moving from A to B. And in your books, the books don't really care whether you're moving it from your savings to your checking, because it's still property and an asset of your business. It doesn't matter if it's in liquid cash, like bills on your desk, or if it's in a bank account. The business doesn't care, the books don't care. It just cares that you own it. Once you pay it and it goes away from you, then the books care. and they want you to document that. So owner draws or personal spending from business accounts, any commingling, again, don't do that. And then deposits that are not sales. So for instance, if you apply for a line of credit and you're infused with cash of like $5,000, that is not a sale. So registering it as income would be the incorrect thing to do. The proper way to record that loan, it would bring in money into your cash account, but it would also create the liability account because it means you owe that money back to your lender. And so it would be counted as a loan. Or if it's an owner's contribution, if you put the money in, you're like, I have this in my personal funds, I want to seed my business, or I know that I need more money because I'm going to do this event. I'm going to put in $500 so that way my business has a little more cash to work with, and you would record that as an owner's contribution, not as sales or as revenue. Refunds also, like if somebody overcharges you and then they give you a refund, that doesn't go into sales, that would go into the category you originally spent it. Like say if you paid extra for your insurance and they're like, oh, actually, here's $30 back. It would go back into the insurance category where you originally spent that money from. Your payment processor deposit, so Square, Stripe, PayPal, Shopify. Make sure that you're parsing out what was a fee to these payment processors and what was actually revenue, because it's good to see that breakdown so that way you don't get taxed on that money that you didn't actually receive because you actually had to spend it before you even got it because the payroll processor is taking their cut. So that's why it's good to record that. Sales tax collected, if that's applicable to you, you want to record that with each transaction. And that would show up as sales tax liability because you owe that to the state to pay that on a usually quarterly basis. Equipment recorded as supplies. So if you have a computer, that's not actually supplies. That's an asset. That's equipment that you use to run your business. Whereas if you have, so like if you're making bath bombs, right? The bath bomb press is not supplies, but the baking soda and the citric acid and the perfumes and the colorants, those are supplies that would be for the bath bomb. So that's kind of the distinction between the two. Business versus personal meals. Obviously, you don't want to take you don't want to do any personal meals on your business account because that would be commingling. And again, that can jeopardize the integrity of your business reporting. And when you do have a business meal, I always recommend that you document who was there, what was discussed, what was it for, right? Make it legitimate, that it was truly a business expense. So nobody is left wondering. And then finally, vehicle costs. For smaller businesses that are just starting up, you can just record your mileage. And then at the end of the year, you can give that number to your tax accountant. And there's always a standard rate that they can deduct from your overall revenue. And then you don't get taxed on that. That's usually the easiest way to do it, especially if you're not big enough to have a dedicated like business car, automobile, then I would just recommend recording your mileage and giving that to your tax preparer. All right, so one-off or special transactions. When you buy a fixed asset, in the accounting and bookkeeping world, there are two types of asset. They call it a fixed asset and a current asset. And a fixed asset is an asset that is over $2,500, and it adjusts by the tax year, but it's a large purchase. So if you're buying a computer, a vehicle, you know, that fancy bath bomb press that maybe costs several $1,000s, or like an oven, like a large commercial oven, anything that's over, you know, $2,000, a lot of furniture, like a big desk with all of the bells and whistles and holders, the right ergonomics for you and maybe a partner that's working with you or other people that will be visiting you, like customers. Those are fixed assets. Those are larger, and you would depreciate those over time. New loans or lines of credit. Again, like making sure you're recording that properly. You can talk to your tax preparer, consult a bookkeeper on how to do that. You can also look on Gemini, like Google Gemini or AI Claude, and you can ask them and it knows a lot of stuff. And you're like, hey, I'm getting this line of credit. How do I properly record this in my books? Definitely have a conversation there. It's free and it's usually pretty accurate, especially for these simple transactions like this. Grants or program funding, again, it's recorded similarly to a loan. If you're a nonprofit, you do have a different layer of categorizing where you would want to categorize. If you are a nonprofit, just write that in the chat and I could talk about that a little bit. But there's like an extra level of categorization for nonprofits where you also have to state whether any monies received are what they call restricted versus unrestricted funds. So if someone's donating and they're like, I want this to be for this specific program, or they could say, you can do whatever you want. This is just a general donation for your organization. It could go to administrative, it could go to this project, it could go to a different project. We don't care. It could pay your insurance. It's unrestricted, right? Refunds, chargebacks, reimbursements, that also you have to sort out basically the standard operating procedure of how to handle those, and major repairs and replacements. All right. So quick chat check-in time. Is there any one of these that you're unsure of how to categorize? Like a loan payment, credit card payment, owner's pay, payment processor deposits, or all of the above? Oh, either everybody's keyboard is broken or everyone's asleep. Or I've done a really good job of explaining this, so hopefully it's the latter. All right, so now on to step 3, reconciling your accounts monthly. Again, a month feels like it could be a long time, right? Especially when there's, in the world of business, so many things come up and you have your life, you have everything. And so visiting your books and just doing it again. Oh, somebody said credit card. Okay, we'll loop back on that. Visiting your books once a month is a good cadence to do because it helps you, it's still front of mind enough that you can go back in your records and be like, this is what I spent this on. I don't recall this expense. This is basically the process of looking at your account, how you've recorded it in QuickBooks, Xero, Wave Financial, whatever software you're using, and comparing it to your statement. And your bank statement shows you what money came in, what money came out. And then the program is showing you what has been recorded. And by matching those up, that just says, yes, the monies came in or the monies went out this way. This is true. And you can catch a lot of mistakes this way. I love doing financial reports for my clients because when they come back and they tell me, oh, this was actually supposed to be categorized in a different way, or we're supposed to handle this different. This was a prepayment from a client. I haven't actually delivered the services yet. I can go back, I can correct it early before it all piles up and then they lose their memory of it. So I love the monthly reconciliation process. And yeah, and when you get everything lined up, it's really satisfying because it happens super fast and you can reconcile it in a heartbeat and you're like, yay, I'm done. So even if you categorize weekly, the monthly reconciliation will help you catch missing transactions. Say if you thought you paid for something out of your business account, but then you're like, it's not showing up on my statement. I have it in QuickBooks because I logged it as an expense, but it's not on my statement. Then you can go back and say, I used my personal credit card to pay for that. So then you can decide if you want to reimburse yourself, like as a owner's contribution to the company, or if you just want to log it as an owner's contribution and not actually transfer the money in the books. It can help you find duplicates. So maybe you uploaded a bill at the beginning of the month and then mid-month you're like, oh, I have to upload this bill, and you do it again. It'll help you catch that. If there's a bank error or a transfer error, you'll catch that too because the numbers won't match up. Or anything that's miscategorized because you're looking at your monthly report and you're like, wait a minute, why do I suddenly have $400 in this account that's usually only 20, and you're like, oh, I put it in the wrong bucket, that expense, that's why. All right, so I'm going back to the question because somebody said that they're a little unsure on how to categorize credit cards. Are you talking about, oh yeah, credit card payments? Do you want to talk a little bit more about that, Marion? Or you can chat it. Yes, it is still confusing how to track credit card payments. Okay, wonderful. So when you have QuickBooks or Xero or Wave set up, you're going to have multiple accounts up at the top. You'll have your checking account, you'll have your savings account, and if you have a credit card, you'll have a credit card account. And each time transactions go through any one of those, say, 3 accounts, you'll have what's called a bank feed. And so whenever you buy something with your credit card, when you are in your credit card account over here, it will show up that you paid for office supplies at Staples. And when you categorize it monthly from the bank feed, you will categorize it under the Amex account as an expense for office supplies. And then you'll click post and it will be posted and recorded in your books that you spent $16 office supplies at Staples. So then you have all these other expenses and things like that. And then the month end comes and you have to pay your credit card bill. So you're going to pay your credit card bill from the money from your checking account to your credit card. And if you say, I'm going to pay my credit card, it's going to be a credit card expense, you're basically double paying your expenses. Because when you logged that Staples expense and said, I spent $16 at Staples under my credit card, you've already told QuickBooks that you've spent that money on office supplies. If you also tell QuickBooks, I've spent, $428 to pay off my credit card, all the expenses that you categorized that you paid for with your credit card the first time, it will show that you're also paying another $400, whatever the balance is of that credit card, again. And so QuickBooks will think that you spent all the money from the credit card and you spent the money from that checking account because it's an additional expense. Whereas the proper way to do it when you pay that credit card off is you record it as a credit card payment, which is basically you're transferring the money from your checking account, the cash, to eliminate the liability of what you said you would pay to your credit card. So you're not double counting it as an expense. You're basically just saying, oh, I've paid this off. The liability is I have fulfilled my debt to the credit card company. And so I'm going to take this cash. That's where that cash went. That cash is not going to be spent on additional expenses because the expenses were captured the first time when you spent it and swiped the card and categorized it under your credit card account. All right, so hopefully that makes sense. But then how do I know if it was office supplies or a subscription? Oh, when your books will show that when you categorize it under the credit card expense, you will categorize it there and that will stay there. So it doesn't wipe out all the history of categorizations when you pay your credit card. All of those categorizations, yes, will stay in place. Yes. There is a paper trail. All right, so step 4. So once the transactions are categorized and accounts are reconciled, so everything you've said, this is office supplies, this is subscriptions, this is rent, this is all of that, and you've checked it with your bank account statements, you've looked everything matches, you haven't duplicated anything, you haven't missed anything. You can just do kind of a gut check. Does the income look reasonable for the period? Do the expenses make sense, right? Like is something high? Like I said, oh, this category usually is $20. Why is it $400 this month? Some people will have categorizations called miscellaneous or uncategorized or ask my accountant. And that's a dangerous slippery slope, because at the end of the year, you don't want to have a whole bunch of things where you're like, I didn't know where to put this, so I just threw it here. Find a place for it. Even if you have to talk to, Gemini or something, say, I have lots of expenses doing this. What should I categorize as? Come up with something. Owner pay and transfers are not showing as expenses. So you want to make sure is that they're showing as equity, whether it's owner's contribution, you've put money into your business, or an owner's draw. You're making so much money, you have so much business money in your checking account, your business checking account. So you took a couple thousand out because you've earned it. That's an owner's draw. It's not an expense. Loan payments aren't overstating expenses. Basically, it shows that your loan payments are going to pay that loan down. It's not paying for an additional something, right? It's similar to the credit card idea where you're not paying, you incurred the expense of the loan when you first got it, but paying the loan off, you're just refilling what you've promised you would pay. The payment processor income and fees look accurate, and that your cash balance matches what you expect. Right? So why do you do this? You can catch errors easily. It keeps your books accurate, and it helps you trust your numbers, right? And your business decisions are based on data, which is really important. It's heartbreaking to me when people are like, I don't trust QuickBooks, because that just means that they're not doing these basic steps and their data is not good. And so then they can't really use this information to see how or track how they've been performing. And then they can't use this to make good decisions. So you can trust your numbers when your numbers are accurate. It also makes funding readiness easier. It helps you decide if you're like, oh, I don't know if I'm ready to take this adventure, to take this leap. Like, how many months do I have before I'm going to run out of money or need to open up a line of credit? You have the books, you can kind of look and say, each month I've been spending, these are my expenses. I can forecast out from that if these numbers are accurate. So simple habit, categorize weekly, look at all of the transactions that come through all of your accounts, your checking account, savings account, credit card accounts, put them in the right buckets, reconcile them on a monthly basis, review the reports, rinse and repeat every month. All right. Any questions so far? We're going to start talking about the 3 key financial reports. Get a drink of water. All right. So you may have heard of the term P&L. It's also called the profit and loss or the income statement. It's money in, money out. In the nonprofit world, they call it the statement of activity. Money in, money out, things are moving. What are the activities? Things are moving in and out. You have a second financial report. It's called the balance sheet. And it shows you assets, liability, and equity. So if you think back to the big 5 categories, and we'll talk about this, the big 5 categories on your chart of accounts, income and expenses are on your income statement. And the other 3 assets, liabilities, equity are on the balance sheet. And they have an equation that balances it out. In the nonprofit world, it's the statement of financial position. Then you have your cash flow statement. It just overall shows you where is the money moving overall over time. And that helps you think about how much cash you actually have on hand. We'll talk about that too in some forecasting. This is a really fun little napkin finance sketch. And the reports, right? You've got the 3 major reports: cash flows, income statement, balance sheet. I think most people use income statement, balance sheet. We're probably the most familiar with an income statement. It mirrors kind of our own personal finances when we look at a statement, the money in, money out. Why are these reports important? For internally, we can track our growth. Do we have enough cash? We can manage our resources. And then externally, it can tell people, are we a good investment? If they're looking at our business, they can assess the management. Like, are they keeping track of their finances? Are there any red flags here? Like, are things not matching up? Like, you can tell that by looking at financial statements. So the big one, profit and loss. This is the one that we're the most familiar with because it's a lot like our personal finances. Shows money in, how much your money is made, how much money your business has made, how much has gone out. It shows at the bottom line, right, is the last. So at the top, it's always income, in the mid, and then you've got cost of goods, you've got expenses, and then you've got your bottom line. And it's either a positive number if you made more money that month, or it's a negative money number if you've made a loss that month. And why does it matter? It shows if your business is profitable. If you're seasonal, it shows you what months are the most profitable, what months are not. It helps you see where your money is going. It's really nice because you can break it apart by increment of time, whether it's monthly, so you can, or quarterly. If you've been around for several years, you can look year over year, all the money in for the year, all the money out. So it's a really good comparison tool. It's definitely required for loans and funding. Most financial institutions will look at your numbers on all three of these statements, especially the two, the profit and loss and the balance sheet, if they're going to extend any sort of line of credit. And so when you review it, you look at, does the income look accurate? Do major expenses make sense, right? There's not a category for like business bling, right? Or something crazy where it's like the business pet, like we love our pets, but are they really essential for our business? Perhaps not. Is there anything unusual or a missing item, right? People are like, well, why you're a major engineering firm? Why don't you have any licensing or insurance on your profit and loss? So either you don't have it or you're not tracking it, and I can't trust your numbers. Simple takeaway, like, are you making money? That's why it's really important. So revenue sales minus expenses is equal to net income or profit or a loss, hopefully not a loss. And I always think of it of like, when they think of like gross revenue, I think of it as like a hunting analogy of like, you go out in the woods and you kill something, it's all bloody and gross. And then you clean it up and you get down to the bottom and you take home the good stuff in your net. So that's the net income. After you've processed it, you've taken away all of its expenses, you've got the net income. And the gross income is the big part, trickles down, clean it up, you've got the net income or net loss. All right. So the second one is your balance sheet, right? So I mentioned like you've got your income and expenses are the two categories, and the other three are assets, and they're always equal to liabilities and equity, and it balances, right? And this one's a little bit more abstract, especially for new business owners, because it's like these numbers don't move, and they're a little bit more abstract, right? But it shows basically on the assets what you own, right? Here, cash, machinery, land, or property. What do you owe? Your liabilities. So your credit cards, your loans, your sales tax that you've collected that you haven't yet paid, those are liabilities because your bills that you've accrued that you haven't yet paid. Because if you were to stop at this point of time, that would take away value from your company. It's a liability. And equity is like, how much money have you put in? How much money have you taken out? It's the kind of the evaluation of your company, which doesn't really mean anything until you actually want to sell it. And that's why it can be kind of abstract. This term retained earnings, basically at the end of the fiscal year, like on December 31st, whatever year, whatever your net profit or loss for the year on your profit and loss, your income statement, that number gets captured and put into retained earnings. And that just shows whether you're profitable or not profitable year over year. That's all it is. But again, it's an abstract figure, and it only matters if you're looking to sell your company. Yeah, so it shows what you own. It shows what your company owes. It shows the valuation or the equity and what belongs to the owner. And it shows an overall financial health of your company. So people who are lending like to look at the balance sheet, because if your books are not tidy, this is where they say the bones are in the balance sheet, because this is where it'll pop up if your books aren't being kept well. It understands your financial risk, because if it looks like you have a lot of cash, but then you also have a lot of debts. Like maybe a lot of people loaned you money and your liabilities are also really high. So maybe you're not that safe of an investment, right? If that's properly logged. It shows the amount of equipment that you own, and owner activity. Like, are you taking a lot of money out of your company all the time? That will show up on the balance sheet here under equity, right? Because again, your owner's pay is not an expense, it's equity, and it stacks up year over year here. At the end of the year, there are certain accounts on the balance sheet that reset to zero. Similar, like owners' draws and contributions can reset at the end of the year if you're tracking it for like your personal pay. And there's other things that can kind of reset at the end of the year as well. And so you can use it to look at your cash, your loans, balances. Does it look accurate? And so this report answers, where does my business stand right now? Again, it's the valuation, and it really only matters if you're looking to sell your company. But it's also good to have. All right. So has anyone, if you have been doing some business, have you ever been profitable on paper, but you're like, where's the cash? Like my reports are saying I should be profitable, but where is my money going? Yes, no, or not sure. Okay, I've seen some not sure yet. It's not there yet. Totally fine. Well, if you ever do run into that question, and hopefully you'll be on guard for it, that's a cash flow issue, right? And so that leads us into the cash flow statement. So a lot of times, like when you deliver a service, there's a lag from when you'll actually be paid. Hopefully, if you have a business model that you get paid right away upon delivery of your service or even upfront, that's great. Then you might never run into a cash flow issue. But for most businesses, they will deliver a service and then they invoice afterwards. And then there's like a net 30, which means they can pay within 30 days or 45 days or whatever terms. And so a cash flow statement will show you how cash has moved into and out of your business over a period of time. It tells you where the money is coming and where the money is going. And it can help you explain why cash feels tight, and it can help you forecast for what's ahead, right? So if you know your annual payment for your insurance is coming, and that's several $1,000s or $1,000, you can kind of know, like, in this month, my cash flow, I'm going to have to pay this large amount because it covers my entire year. So it can help you spend your money smartly, right? It also helps you see, like, are you paying your customers, or your customers paying you on time, right? If that net 30, you're depending on that money to show up in your bank account, they're not paying you. Like, they're paying you net, 35. You have to bug them a couple of times. In which case I recommend instituting a late fee, like a 3% late fee, and that usually helps people whip into shape. And you can even remind them, like, a couple days before it's due, be like, hey, just want to help you avoid the late fee, pay your bills on time, looking forward to that payment, that remittance, like when you're going to pay me. It will tell you, are your bills or debt draining cash? Is cash flow improving or declining? So basically, this report answers, do I have enough cash to operate? And it can get very complex, especially when you have a lot of different clients on a lot of different payment schedules, and you have a lot of people on payroll, right? It's a little more simple when you're just one person, but it is a report that's available for you to build and cultivate that helps you kind of bridge these feelings and these times when money can feel tight. And so cash flow is about timing, right? You might have a bunch of invoices out that people are going to pay you, but if they haven't actually paid you, you're not going to have the money in hand. So that's why, like, if you have a credit card, it can kind of help float you to bridge those gaps, but it still will make you sweat. And I heard someone say once that once you start your own business, you sleep like a baby, sleep for 2 hours, wake up and cry, sleep for 2 hours, wake up and cry. And a lot of times it has to do with cash flow. One late payment can throw everything off if you're that tight. Everything comes before, like, bills, payroll, taxes, everything comes out before you are paid. And so these are all reasons why cash can feel tight. So you could do like a 30-day forecast. You can forecast for money coming in within the next 30 days, expected deposits, the invoices or sales that you've made, and the money going out. So you, especially if you've been tracking regularly, you know how much your bills are going to be, how much the rent's going to be, you know when that annual renewal for your insurance is going to be. You know what to set aside for taxes because you checked in with your tax preparer, and you kind of know 30% or 40%, whatever your brackets are for your business, what to expect, and then what's left. It can kind of help you guide your decisions. And so obviously you want to do that because it raises red flags early and it helps you avoid problems. So if you can see 30 days ahead, you can make better decisions today, right? So budgeting for operations and growth, you can create a budget and you can say, well, and you'll know that by your history and it will mirror your history a lot. And then you can forecast out and you can make sure that your budget is covering those day-to-day expenses because it's not a surprise to anyone that your rent's going to be due in the first of the month. And then it can help you plan ahead for, again, those just irregular, this is the time of year when I pay my insurance premium for the year, so I get that discount. Set aside money for taxes, and you can be really intentional about your spending. It prevents surprises. It helps you decide what you can afford. And if you want to grow, if you want to try a new event, or if you want to try a new product, a new service offering, it kind of helps you figure out where you can pull some strings and levers, and you don't have to guess. All right, so this is kind of a budget versus like a 30-day forecast, right? So on the left, we've got budget. It's your monthly plan. It's kind of estimates, it shows where the money should go. It helps with planning, it focuses on categories. And then a 30-year forecast, it's like a more short-term cash view because it's only 30 days and it's based on real timing, shows where the money moves, avoids surprises, and it focuses on real dates. Like you're pinning dates to when the cash moves in and out. And that's the difference, like a cash flow statement versus a budget, because it's pinned to those timelines. Hopefully you are running your business, right? Because you're doing this because you're offering a service or a product that you really believe in, and you don't want the books to weigh you down. So if you're ever looking for funding, and that could be as simple as a line of credit. Like nowadays, everybody wants to lend you money. Like if you have QuickBooks, a little pop-up will be like, open a line of credit. Like I have my business checking account, says you're pre-approved for a line of credit. And why they're offering that is because they look at your numbers and they're processing it already. They're looking at the information on your profit and loss and balance sheet, and they've kind of already run those numbers through their algorithms, and they can see whether or not you're profitable, and so you'll get those offers. And if you are looking for funding, you will want to submit all of these documents for them. And that's basically so they can see that you'll be able to pay them back and within what terms. And so that helps them make an educated guess on how much to give you, and the duration of the loan. And so you need to be very transparent about if you have debts owed to anybody else. You can also write up a business plan and explain what you're going to use the funds for. Like if you're investing in a training, that's going to help you have a level of certification that's going to maybe deliver more clients or attract more clients or allow you to bill at a higher rate, things like that. But you need that education, and that's going to require funds at the forefront. Those are also things that you'd put together with your lending package, your application. And credit information is the last item. When you are a small business, especially as a sole proprietor, your personal credit can be used to impact your lendability, basically. So what are lenders looking for? Can they repay my money? Consistent income, positive or improving cash flow, like you're never having dry spells. They want to see that you're managing your money responsibly. You have reasonable debt levels, right? Like on the balance sheet, they're not saying that you have a lot of cash, but you also owe money like to everybody and your neighbor plus. That's beyond the cash. So is the business financially organized? Like, do your books look good? Does it look like you're reconciling monthly? Is there a separation of those personal and business finances? And do you clearly understand your numbers? Like, just like when you watch Shark Tank, they are like, what's your margins? What's your this? What's your that? They want to know that you know what you're expecting to pay in your expenses each month. Where's your income? Do you know where your money goes? What is your plan for using this fund? How are you planning on paying this back? Confidence and clarity matter just as much as the numbers, especially like in a personal interview or in that package that you put together. Right. So I think this is our last slide. So your small business, I always hate these acronyms because I can never remember them. I think it's not distribution channel, but it says your small business. Oh, it's basically the government assisted like organizations that can help you run your business. And every state has an SBDC where they help you run your business, and you can apply for financial advisory. And so you can talk to certified bookkeepers to help you get your books set up. They can help you clean things up. If, like, I had a client where someone was like, I had an accountant, my first year of taxes was last year, and they said my books were backwards. Help. They could file my taxes, but they just said I had to figure it out. And it was like a simple thing that they were actually kind of reporting their credit card payments the wrong way. We just corrected it, set up a plan of like, when you see this on your credit card, you pay it this way, not the other way. They were off and running. It was great. So with the financial advisory, they can help you understand your financial reports. You can build a budget and cash flow plan, build a business plan with financial projections if you're looking for funding. Look at the funding opportunities. They'll even help you look at your loan requirements and documentation to see if your package looks credible. For you to understand your credit readiness and how your personal may interact with your business credit worthiness, and help you create an action plan for your stage of business, like whether you're launching it, whether you need to work on your marketing, or responding to requests for proposals, like whatever strategy you might have. So, all right. So are there any questions? I'm going to Google SBDC because it's going to bug me if I don't tell you what SBDC stands for. And I know it's super simple. If Christy were here, she would kick me under the table. Small Business Development Center. That's what it is. And I know this was supposed to be a 2-hour webinar or workshop, but I blew through all the content. Does anybody have any questions? You mentioned several different bookkeeping programs, QuickBooks, Wave, Xero. Yes. What are the differences? Yeah, taking it all in for sure. So QuickBooks is kind of the #1 gold standard. They've been around the longest. They are very robust, and it takes a little while to get to know their platform, but what's great is that they're infinitely scalable, and they have packages at every level, whether you're just starting out, and it could cost as little as like $38 a month for like full bookkeeping, because now it's all subscription based. Everything is subscription based. You don't just buy it and then use it. Is Google Sheets a good tool for this? You can track your books on spreadsheets. You cannot generate a profit and loss or balance sheet. So if you're looking to just track your expenses and do basic tax reporting, yes, you can do that. And you can still categorize, like if you have a spreadsheet that's set up, there are even templates like basic spreadsheet-based templates that you can find online, and it will sum things up and you can categorize it there. What's really nice about QuickBooks though, or Wave or Xero, is that you connect your actual bank accounts to it and your credit card accounts. So that way, when the transactions happen, it shows up on the bank feed. And when that shows up on the bank feed, you can actually do your bookkeeping instantly. Because as soon as the transaction happens, you can say, oh, this was office supplies. And as soon as you hit that, it's in the books and it's recorded. So it's very, very nice to have. I can show you. Let's see. I personally I prefer QuickBooks. Not just because I've been trained on it, because I did start off with Wave Financial and it was very simple and I like that. So for beginning business owners, I would say, you know, that's actually a really great, a great option. But QuickBooks allows, like, as you get higher in the tiers, it allows you to, you can invoice directly from QuickBooks. You can also do it with Wave and Xero. It's Xero with an X, Xero. So QuickBooks has a test site that you can go in and you can play with it. And they've pre-populated it. You should know that it is actually some bad books. And so bookkeepers in training use this to look at QuickBooks and then they fix it up. So they're always redoing their layout. So if you looked at this 2 years ago or even a year ago, you wouldn't see this format. They're always optimizing. They're always adding bells and whistles. It looks really confusing because this is capable of running a massive enterprise with multi-facets. And so really what you would just need to focus on is just a few things. And so they have these items here, these little pills up here, and they call this Craig's Design and Landscaping. So if you Google it, you could say, you know, QuickBooks Test Company, Craig's Landscaping, and you can find this anywhere. They have the accounting app, the expenses and your pay bills app, your sales and get paid app, and the customers hub. Customer is anyone that you receive money from. That's the difference between a customer and a vendor. A vendor is someone you pay money to. Payroll, if you have that, you need the diamond, like a higher level for that. Team, if you have team members, you can log time on projects. You can record inventory, sales tax, business taxes. Like I said, this is very robust. You can do lending. They're even doing like CRM, a customer relationship manager through QuickBooks. Like I said, it's very robust. And so new business owners get a little bit confused and intimidated by it because it is so robust. But honestly, and you can get to the apps here as well, what you need the most is the accounting, and like I go to this all the time, is the bank transactions. And so when I was talking about you connect your accounts to QuickBooks, you would just link it. You would like go up here to link account, and then you would sign into your bank through the QuickBooks platform. And then you can see here, these are all the transactions that went through the checking account that have not been categorized yet. So it's up here, it says pending. Once you categorize it, so like if I look here, books by Bessie, and it already has a chart of accounts listed, and you can do a drop down and you can see like books by Bessie. We can say, what is books by Bessie? Let's say they're a bookkeeper, books by Bessie. So you would categorize it. And when you click into it here, if they sent you an invoice, you could literally drag it into anywhere on this box, or you can upload it here. You can write this memo if it's like invoice 4332. And then you can, if it was like an unusual thing, it was like a cleanup, or you could write monthly fee or whatever notes you want to do. You should even have Bessie here as maybe one of your vendors. Oh, it's received. This money is received. So see, that's another thing. They're probably not a bookkeeper. So it's somebody you did work for. So this would be revenue. So maybe you did some design income, like you designed some of their water fountains or something. And maybe Bessie is not in here yet. You can add a new customer in here. We can just type it in. Oh, they are here. They are a vendor. Interesting. Why did she send me money? She's my vendor. I don't know. But you would know because you would be part of it. So then let's just say it is bookkeeping. Maybe it was a refund. Well, let's just say refund. Because it's a deposit. And then if you want to attach your documentation, you can do that. And you would just hit post. And then once you hit post, see, you're doing bookkeeping with me, it's gone from this line item. And then it goes into this category here. And it's here and posted. And I could undo it, or I could look at the deposit. I can go back and change it. None of this is permanent. You can always find it. What's really nice is the search bar up here. If you know the invoice number or transaction amount or anything this is tagged to, you could say, oh, it was a $55 charge. What was it? And then here, anything that was $55, it comes up with line items, or anything that's like 55. So this person's phone number comes up. This is incredibly handy. If you know the person's a customer name, you can put it in up here. If you know menu option in QuickBooks, you could put it up here. I use the search bar constantly. And then you would just go through each month or each week, and you would categorize each item here. So here, like I rented something, equipment rental, and QuickBooks, they have AI. They will automatically say, based on historicals, you rented at A1 rental, equipment rental, and you like post that. And it wants to know more, like I'm creating A1 vendor rental. And you can add all the details in here and it saves it as a vendor card, right? Again, it's very robust. You could put the address in here, sales tax ID. A lot of times you could just ignore it and you're going to be okay. Yeah, and then once everything is categorized, and so here is like the MasterCard account. And so it's very subtle, but this is green now. So I know that these are all transactions that went through the MasterCard, right? So then if I say I post it to do the subscriptions, and so here there have been some expenses that were already entered, and QuickBooks knows that this expense happened because you've logged it before, or whoever did the books here was proactive and they uploaded this expense, the receipt before. And so it wants to match it for you. And if it's correct, you will match it. And then here, if it's like, no, it's not Bob's Burgers, it was the same amount, then you could go back to categorize and it was your previous menu and you could recategorize it as something else. But since we know what it is, then we match it as it was a credit card expense, and then it gets paired off and then it shows that that receipt was closed out. And so you just do all of these things, and then you would just go to reports at the end of the month once all of this is done. And you could just hit make me a profit and loss, right? So this is the part that is difficult to do from a spreadsheet. And sorry, Marion, I'm just seeing your question. It says, can this be done for transactions in the past? Yes, you can. When you connect your account to QuickBooks, it'll ask you how far back in the history you want to import the transactions. So that's when you would set like the beginning of the year, probably, if you want to start from the beginning of the year, or if you want to record all of the transactions, you can do that too. If you have a lot, you're going to have a lot to weed through, but if you want to capture it all, yes, you can do that for things in the past. And then it'll just keep updating into the future for as long as that account is connected to your bank feed in the accounts. So here you have a profit and loss. You have cash basis accounting, which is what most people know. It's when the cash comes into and out of your account. Accrual basis accounting is more like future forecasting. It's money that's owed to you. So when you write an invoice, it considers it as income on the date of the invoice that you wrote the invoice, even though the money has not hit your account. Similarly, if you have incurred a bill, that is considered an expense the day that you incurred that bill, even though you haven't paid it yet. That's basically the difference between cash basis and accrual basis. And you can change the dates up here. So it looks like it's the beginning of the year to date. And so I always love to do it by month. And this is where it gets powerful, is because this is where you can compare your activities month over month, right? So here we've got income, it's growing here. Okay, discount given there. That probably shouldn't be a negative, but again, it kind of shows you month over month. So these were all of my income amounts, and it tallies it all up here. And then moving down lower, you've got all of your expenses. So here's the gross profit. So they always take cost of goods sold before totaling out the gross profit. And then you have all of your expenses, your automobile, and then you can compare month to month across here. It compares the total for whatever time span you've selected, and then it totals it out. And then it shows you net income was negative 300, slowly growing, kind of dipped back down. And this month you're not seeing a lot of stuff because if the transactions are not categorized from the bank feed, they will not show up on your reports. They don't exist yet until they've been categorized. Okay. So until they've been posted on those bank feeds, you will not see them here on the profit and loss. And then here you can also just say, show me a balance sheet. And a balance sheet is a point in time. It's what is the evaluation as of this date here, like today. Even if the date says like end of the year, it's going to be today. You can also set it for the past, but it's a point in time. So you could do display columns by month, but it doesn't really make sense because the valuation of what your company was worth a month ago doesn't have really much bearing on the evaluation of it today. So usually it just shows you your current assets, checking account, savings account, receivable. So what do people owe you? What are you expecting to receive? Other current assets, so like inventory asset, because you've got stuff ready to sell. And then undeposited funds, that basically means he has checks that he hasn't matched up to invoices. That's like only available in cash basis is undeposited funds. It's a weird term, but once you deposit it, you don't even have to, you're supposed to tell QuickBooks when you receive a check before you deposit it, but I just deposit it and wait to categorize it once it pops up on the bank feed, so I avoid this altogether. Yeah, your fixed assets, again, those are your larger assets as opposed to current assets, which will usually shift or go away within the year. And then fixed assets are not only a high ticket item, but they will last more than a year and they're going to stick with you more than a year. Liabilities, so he's got $1,602 in bills. He owes $67 to pay off his MasterCard. And then he's got some Arizona taxes. I see a question here. So when you set an invoice, do you have to match it with the check? Oh, the check that comes in? Like when somebody pays it? Yes. Yeah. So yeah, let's finish looking through here. So other current liabilities. So this is basically stuff that you have to pay back. Well, he has a loan. He has a note as well. So maybe his dad or uncle gave him $25,000 to start this landscaping company. Equity, again, opening balance equity. That's the opening valuation of the account. Again, it's very abstract. It doesn't really mean anything until you want to sell the company. Same with retained earnings. And then net income, that comes from the profit and loss onto here. It shows up here, and then it always equals out the total for liabilities and equity. They always make it match the this number here. Total for assets, 23,436, 23,436. To answer the question, when you create an invoice, let's see here. bank transactions. I don't know if he even has invoices. We can look here under sales and get paid are invoices. Yeah, look at that. And so you can create all of these invoices in QuickBooks. And again, it looks intimidating, but if you just look at it line by line, it tells you the invoice number, it tells you the date that it was created, and it tells you the amount that it's for. It tells you when it's due or if it's overdue. You can receive payment here. I like to receive payment on the bank feed. So when I actually see the money come in, I match it just like I match the expense. So yes, basically. So when I'm looking at the invoice, and you can customize this as much as you want. Again, it pulls information on your customer, and then you can set your products, and you can preset it to automatically populate the value, the rate for each item, or it could be just a service, right? Like if you have a brand new one. And then like, since I have a lot of service people here, you could say a service. Your service would be like a translation. A document, perhaps. And so you can choose the category of it. It doesn't fit into any of his landscaping categories, obviously, but this is where you would say if it was a physical item, if it had sales tax, you could set a rate for it. So maybe you charge $80 an hour, and the income account that it lands in, that's from your chart of accounts. So here he has it all broken out of all of his income. It could be pest control services, sales of whatever. You could do services, whatever you decide, and it could fall into one bucket if it makes sense for you. And then whatever, save and close. And so translation of a document, and you could say document submitted by Fred for immigration, perhaps. And then worked on it for 3.5 hours, and it automatically computes the rate. If you want to do that, you can also adjust it and just say, you know, I'm going to just charge 75 for this. And then it automatically has that. You can delete these here. You can change the invoice date to actually be today. If you go in QuickBooks and just hit T, it will do today. And you can say it's net 30, so it automatically calculates 30 days. It automatically gives you an invoice number. You pick where you want to start from. It starts with 1, which nobody likes to start at. You can tell your customer how you want to get paid. You know, obviously QuickBooks is like, oh, use our financing, and they always offer that. But and you can customize it with your logo. You can do all of this, you know, changing modern template with different colors. And then tell your customer how you get paid. Cold hard cash. Have a great day. And then you can save it. And then you can preview it by printing or downloading. And so this is what the PDF, or if you're printing it out, this is what it's going to look like. And obviously you can change and customize it all to you. You can upload your logo. And it has all the details that somebody would need in order to pay you. If you do use QuickBooks's payment things, they'll have a button that's hyperlinked to a website where someone can just upload their credit card or their ACH information. And of course they charge a fee, but they'll have a button there so you can get quick payment. And then as soon as it's paid, QuickBooks will register that in their it'll show up on your bank feed and it will suggest a match for you. You can have it automatically match for you, but I don't like doing that because I like to at least review it before I accept transactions. Yeah, and so then you can look at all of your customers here. And then each one you can click into them and it has all their information from their address, their email. It shows you their open balance here on the right. Yeah. If you have a lot of invoices out and you're like, I want to know who owes me money. Like, I don't even know who owes me money and how old this stuff is. Like, you can run an accounts receivable aging detail. And then you can also go through it and be like, oh, am I staying on top of this? And it breaks it out for you of like, who owes you 61 and 90 days past due? And you're gonna be like, oh, Red Rock Diner, you owe me money. I'm definitely gonna apply my late fee to you. And then, you know, these people here, it tells you each invoice. And whenever you see a hyperlink on any report, you can right click, you could click through, but I like to right click, open it in a new tab. And it will take you to that invoice. Or if it's on the profit and loss, it'll take you to the register and it'll show you every transaction that added up to that main category total. So you're like looking at this and you're like, oh, they originally owed me $450. They paid 300 of it. So they have a balance outstanding of 450. So then I can go and I can call John Melton, be like, hey, John, I see that this is overdue. And get that settled. And so this is why I like it on a separate tab, because it always takes you back to the home screen. And then if I go back to my other tab, then I still have my report to work off of. And you can export it to QuickBooks. You can export it as a PDF or what have you. So all of this information. So it is kind of like more technical. It's not as soft and I guess user-friendly looking as compared to Wave or Xero, but yeah, I've gotten really used to it, but the same basic things, you can accomplish all the same basic things with the other software as well. All the same concepts apply. Okay. Any other questions or anything else you want to see? If not, I can cut you all loose and you can have a free half hour. Walk the barking dog. Go have a snack, stretch. All right. Well, thank you all for coming. Thank you for your time and your great questions and your participation. I wish you the best of luck in your business endeavors. And yeah, I'm glad you liked the little run through of QuickBooks. It is a useful tool. It's fun to play with, but yeah, reach out if you have any other questions. And yeah, good luck. See you in the Forbes 500 maybe. All right, bye-bye.